Welcome students to part 2 of financial management chapter. In this chapter we shall be seeing the finance function or financial decisions, their meaning and factors affecting. Financial decisions, as you can see, is into three parts: investment decision, dividend decision and financing decision. These decisions are concerned with the optimum procurement of funds, best utilization and utilization of their return. Investment decision, it is concerned with how the firm's valuable funds are to be invested in various assets. In business, there are different types of assets. As you can see, land, equipments, furniture, factories, building, all these are different types of avenues in which the firm will invest and they will earn some money. The investment decision is divided into two parts: long-term and short-term funds. Long-term funds or investment decisions like capital budgeting decisions, that is purchase of new machine, opening of new branch, etc. These are invested for a period of more than maybe say 3 years to 5 years or more than that, and these are likely to yield a better return if they are invested in a very prudent manner. Short-term investment decisions like working capital decisions, these are related to day-to-day workings of the business, like level of cash in hand, inventory, debtors, prepaid expenses and accrued income. All these will become the working capital of a business. All these investment decisions will also result and also influence the profitability of any business and fund requirement for that particular business. There are several factors that affect the capital budgeting decisions. In capital budgeting decisions or investment decisions, we are mainly focusing on long-term capital, long-term assets, and short-term assets are being dealt differently in a different section and last section of the chapter. There are various factors. There are many factors that will decide whether how to and how much to invest in a particular project or not to invest in a given project. The first point is cash flow. The inflow and outflow of cash in a business should be considered before making capital budgeting decisions. Some projects will take a long period of time to start the inflow of cash. For getting an inflow of cash, we must always be focused on how much and how quickly we are going to get a return, the cash flow. Better the cash flow, more likely it will attract the businessman. Point B, the rate of return. While selecting a project, the rate of return must be considered. As you can see in the box, there are two examples, one circle, another cube is there. Both are showing different percentage of return. One is 10%, another being 15%. If two projects having 10% return and 15% return with almost equal risk, normally the second one with 15% interest may be more likely to be selected because it is giving a higher return with the equal amount of risk. Third point, investment criteria. Investment decisions must be based on certain capital budgeting techniques or calculations regarding the amount of investment. The rate of return or interest rate, cash flow, the rate of risk, the amount of cash inflow, all these different criteria must be taken into consideration while deciding any investment avenue that a businessman is planning to invest. Before making investment, since amounts involved in an investment decision is very large, any wrong decision will result in a very huge amount of loss and loss of business opportunity also. Let us see at a glance. 3 points are there in factors affecting investment decision. First one is cash flow of the project, second the rate of return, and third one is investment criteria involved. The second point in investing after investing decision is financing decision. Financing decision is concerned with the sources of fund for our business. It is concerned with the quantum of finance to be raised from various long-term sources. They are shareholders fund, borrowed funds such as shares, debentures, loan from bank, financial institutions or any other public deposits. But a proper mix of above security is very much essential for maintaining a good capital structure of a company. We cannot only rely on equity capital, we cannot only rely on debt capital, but we have to make a combination, we have to make a mix or equal, maybe more likely equal mix of both the elements, borrowed capital and equity capital in a capital structure. The financing decision is concerned with the amount of debt and equity in a company's capital structure. There are several factors of a financing decision. First one is cost. As you can see in the image, cost is the most important factor, which is the interest rate of any borrowing, and we always try to obtain the fund from a cheaper source which is less burdensome on the company's financial powers. Now second one is the risk. The risk factor in each source must be considered. Like equity is less risky in the company's point of view, but it is highly risky from the investor's point of view. On the contrary, debt is more risky from the company's point of view because it has a fixed payment like interest and principal repayment, and it is less risky from the investor's point of view because it is having a permanent source to the borrowers. C point, the flotation cost. Cost of raising finance should also be less. Example is given, underwriting commission. For issue of shares, there is a cost called underwriting commission. It is given to the underwriters who are maybe financially strong companies or individuals who promise to pay for the shares which are unsubscribed by the company's offer to the public in meeting their minimum subscription. So this flotation cost should also be considered while going for selection of a definite source of finance. But in case of debt financing, legal charges and the manager's commission and other factors are there which comprise of the flotation cost. A manager should always try to focus on this flotation cost also. Fourth point, cash flow position. A stronger cash flow position recommends more debt financing. If the company is having higher debt cash inflow, so it is having a capacity to make timely payment to the debts in the form of interest and the principal repayment, so a company can bend towards the debt financing. Point E, fixed cost. If fixed operating costs like rent, insurance premiums, salary of the business are high, it is better to reduce the debt financing which is having a fixed interest burden on the earning. Since earning is always having some interest, other than interest, they are having some burden of operating the business like rent of the shop or a factory, insurance premium of the entire factory and other stocks, and salary to the employee or maybe permanent employee or temporary employee. These are the expenses which are definitely going to affect the business earning capacity. Apart from that, if some earning is still remaining, it can go for the borrowed capital. Control. More dependence on the owner's fund will reduce the control among the existing shareholders. If existing shareholder is having some percentage of voting right, it will definitely reduce if some new shareholders are added to the list. The old shareholder or existing shareholder will find his control being reduced or being diluted because more shareholders are added to the investors list. Point G, the capital market conditions. During the rising trend in the capital market, it is easy to accumulate shareholders fund. Owners are otherwise it is better to depend on the borrowed fund. If the capital is bullish, as you can see in the green bar diagram on the right hand side of the box, the market is going up. It is very easy to sell new shares and company can very easily borrow funds from the share market in the form of share capital. But if the capital market is bullish, then bearish, not bullish, it is bearish. Bearish means the market is going down. So it is very hard for a company to borrow funds in the form of shares for their new venture. It will be more likely to go for the debts in case market is going down. Let us say this at a glance. Factors affecting financing decision. First one is cost, second risk, flotation cost, then cash flow position, fixed cost, control, capital market conditions. These are all going to affect the company's debt equity combination. Third and last one comes dividend decision. Since dividend is concerned with the distribution of money what company is having with themselves after making compulsory payments to interest holders and to government in the form of tax, then they still have some earning to be distributed to the shareholders. But in the same amount, they still have want to make some decisions. Like you can see in the diagram, there are two persons who are going to control the amount of retained earnings which is going to be held back by the company for further expansion, and dividends which are going to be in the hands of shareholders in the form of their current income. So the decision comes here whether to go for retained earning more and less dividends, or more dividends and less retained earnings. These will be dependent on several factors. Dividend decision, it is considered with the disposal of profit. A portion of the profit is to be retained in the business for growth and expansion, and the part of the profit that is retained in the business is called retained earning, and the rest of the profit which is distributed to the shareholders in the form of dividends. Here is the role of financial management, that how much is to be retained and how much should be distributed. There are several factors which must be considered before deciding how much amount of the dividend should be distributed and how much amount of the profit should be retained in the business for further expansion. Several factors are there. First factor, amount of earning. The dividend decision is always dependent on the amount of profit earned during the current period. If the company is having high amount of profit, then it can distribute more amount of dividends to the shareholders. If the earning is less, if the earning is not so good, then company is bound, it cannot go for higher dividends, because definitely the dividends will be distributed of the company's current profit. Now point B, factors affecting dividend decision. The second point is stability of earning. If the earning is stable, means company is regularly earning good amount of profit, then it can go for higher dividends. Means if the company is having some temporary flux or temporary fluctuation in the profit rise, there is a spike in the profit chart, then it cannot increase dividend just because of 1 year's increased profit. It has to see for the potential has increased, not only a temporary profit is there. Point C, the stability of dividend. It will improve the confidence of the shareholders and higher reputation of the company. If the company's potential has gone up and the company is earning more profits because of its size of the business, not just a temporary effect is there, then it can go for higher dividends and a stable dividends. A stable dividend will create confidence in the minds of the shareholders that this company is having a regular profit and it always gives a amount of dividend that is somehow equal to each year. It will also create confidence and good belief in the shareholders' mind. The fourth point, growth opportunities. Fewer dividends may be given to the investors if the company is having growth potential and expansion projects in hand. If there is company's position has become saturated or it is not likely to grow, so it can reduce the retained earning and increase the dividends. But if the company is having some potential to increase in future, it is going to go for more retained earnings and less dividend distribution. Fifth point, cash flow position. Payment of dividend will involve outflow of cash, and therefore enough cash must be available for the declaration of the dividends. If the company is having more amount of cash, then it can declare dividends, because dividends will definitely require cash to be paid to the shareholders. Merely declaring dividend and not paying anything cash to the shareholder will also reduce the confidence of shareholders in the company's shares. Point F, shareholders' preferences. Normally, shareholders want to get a regular income from their investments, and hence at least a minimum dividend may be distributed every year from company, because every shareholder is having some expectation of some regular profit, because some investors are there who are having their only source of income by means of dividends declared by the company. Point G, taxation policy. If tax on dividend is higher, it is better to pay less by way of dividends, because higher tax on the dividends will increase the burden on the company, and it will also reduce the dividend income in the form of dividend to the shareholders. But the dividends are free of tax in the hands of shareholders, as the dividend distribution tax is levied on the company. In the present tax policy, the shareholders may be demanding more dividends because the taxation policy is going to affect the dividends on the shares. Point H, stock market reactions. Investors generally evaluate the companies on the basis of their dividend declaration status. Higher the rate of dividend gives a positive impact in the market. If there are two companies, one of them is declaring regular and high dividend in the market, their goodwill is going to improve. Another company is there which is very irregular about their dividend declaration, and their earnings are also very irregular, so they are going to have less goodwill in the market. Next point, access to the capital market. Very reputed and having goodwill companies will generally have easy access or reach to the capital market, and therefore they may depend on less on the retained earning to finance their growth. For every company and growth of their company, they need some finance for their further expansion. If the company is unable to invest money or borrow money from directly shares, then they will not depend on their alternative source of income as returned earning for investment in the business. If the company is having poor performance in the share market, so it will have to depend on retained earning, and it will save money by not declaring a lot amount of dividend. There are some legal constraints. While declaring dividends, the company have to follow the restrictions laid down by the Companies Act. If the company law is having some restriction on dividend of declaration, that company cannot declare dividend by selling its fixed assets. So if the company is having poor performance, no profits, it still cannot declare dividends by selling its fixed assets. The last point, contractual constraints. While granting loan to the company, sometimes a lender may impose certain restrictions on the payment of dividends in the future. The person who is lending money by way of loan to the company will sometimes may put some restriction on the company's earning for not declaring much of the dividends, and just to make payment his loan before making payment of any type of dividends. Let us have a glance of this. Factors affecting dividend decisions. Point A, amount of earning. B, stability of earning. C, stability of dividend. Growth opportunities, cash flow positions, shareholders preferences. Taxation policy is also there. Stock market reaction, access or reach to the capital market, legal constraint and contractual constraints. Next things we shall be discussing in the next class. Thank you, class.